Buenos dias, people of YouTube. This is Ryan with trendlizard.com. I hope you're having a fantastic day. So a lot of our videos lately have been educational in nature, kind of targeted towards the beginning stock market investor, where you need to get started, what you need to do to make sure that you're making good trades time in and time out, to have success on a long-term time frame and to make money and to get where you want to be as an investor. And the bottom line, in a lot of those videos is that you don't want to shoot from the hip. You want to go in with a trading plan and understand, one, what time frame you're trading on, understand what needs to happen for you to be right, what needs to happen for you to be wrong, and where to put your stop level to keep your risk tight at all times to make sure you're not getting destroyed by any single trade. So today I want to get a little bit more advanced and I want to dive into more Elliott Wave specific stuff to take a look at how you can take the Elliott Wave theory and make it a very specific, objective, tradable stock market system. So if you can't tell, I'm a huge believer in the Elliott Wave theory. And if you don't know what it is, the Elliott Wave theory is basically a trading strategy that seeks to forecast the direction of price movement. Whether you're looking at the stock market indexes overall or an ETF or a stock, the goal is to determine where the price of that thing is going to go over time so that you can buy it at a lower price, sell it for a higher price, make money, live the good life, and so on and so forth. The two super basic tenets of the Elliott wave theory are that trends play out in five waves. They're strong moves that play out in five waves. These are the moves that you want to trade. These are the ones that make you money. The other one is that counter trend moves play out in three waves. They're less strong, they go against the trend, and they're basically just a stair step that kind of puts the move on pause before more strength happens. So a lot of people use this theory. You can find, I'm sure, a ton of Elliott Wave videos out there, but the information's not very valuable to you unless you can learn how to use it exactly and specifically as a trading system. And that is the goal of this video, to teach you how to take the Elliott Wave theory and make it a tradable system. So when you're making the Elliott Wave theory a tradable system, there's three things that you have to think about that are specific to you. The first thing is, what time frame are you trading? Are you looking for, and again, you always want to trade five-wave moves. So are you looking to trade a five-wave move that lasts just a few weeks, or are you looking for the bigger ones that last several months or even years? What time frame are you trying to trade? That's very important, determining when you're going to get in and when you're going to get out of trades. The next thing you need to think about is, when are you going to buy? At what point in the Elliott wave pattern is it your indication to get in? What is your entry level going to be? So you have to think about that. The third thing you have to think about is, when are you going to sell? At what happens in the Elliott wave pattern to say, okay, it's time to bail, time to get out, time to take my gains and move on. And so those are the things that we're going to address in this video today. So we're going to take a look at a bunch of charts. I'm going to show you different ways that you can check these three check boxes here and develop yourself a very objective, very profitable Elliott wave trading strategy. So let's dive into the charts and see what they have to say. Here we go.
All right, folks. So the first thing you need to consider when you're developing an Elliott Wave trading system is, what time frame are you looking to trade on? And this is a super important question that you have to ask yourself, because there is not one right answer. It depends on who you are as a trader. So are you looking to ride out multi-year moves? Are you looking to enter a trade and sit on the trade for as long as humanly possible? Or are you looking for the biggest, fastest moves in the short amount of time so that you can get out? And there's a couple questions that you have to ask yourself when you are making this decision. One is, how active do you want to be? Do you want to make multiple trades? Do you want to watch the market day in and day out? Are you doing that already? Then you probably want to be more active. You probably don't want to enter a position and anticipate sitting on it for multi years. The other one is, what is your pain threshold? How much drawdown in a position are you willing to sit through while holding a position before you exit? And that's an important question as well, because if you're sitting on a larger time frame, you are admitting out of the gate, basically, that you're going to sit through large pullbacks. You're going to sit through them because you're trying to capitalize on larger moves that continue for, again, even many years, like you're seeing here on this Amazon chart. So Consider this, and it's going to be a little bit of an explanation of the Elliott Wave theory as we go, but there's a lot of different time frames you can trade with this theory. If you wanted to trade this entire advance here on Amazon, you can. You're looking for one big 5-wave advance off the late 2008 low. You have a first, a second, a third, a fourth, and we're in the 5th wave right now of this advance. If this was the time frame you were trading and you were looking for one massive long-term 5-wave advance, you would sit through this entire thing. You would enter one trade back in 2008, and you would ride this out until something indicates that this move is over, and you'll ride it forever. So that would be one thing to do. If you decide that this is the time frame that you want to trade on, you have to be willing to have a high pain threshold. For example, when this uplay completed here, you get this pullback. It doesn't look too big now that this thing is played out, but this was a big move. It moved from about 150 back down to 100. You're talking a pretty substantial drawdown. If you were up a bunch of money, you're going to watch half of that money or maybe even more go away before the uptrend resumes. So you have to be willing to accept that pain threshold if you're on a longer time frame. Maybe you don't want to sit through that. Maybe you don't have that much patience. Maybe you don't want that kind of drawdown. So maybe all you want to do is trade this 5-wave advance here that played out in 2009, and then you want to exit as soon as you have an indication that this 5-wave advance is over. So let's zoom in. This looks at that exact same 5-wave advance. Maybe as soon as you have an indication that this 5-wave advance is over, that's when you want to exit. This would be kind of like a midterm time frame. You buy back in late 2008 and you sit on it for a year. That's pretty substantial. You get a lot of growth that way still. You'd move from 40 up to like 140. Pretty good move. And then you're exiting when you foresee this pullback beginning. That would be another way. Or you could be an even shorter term trader and you could look just to trade this 5-wave move. Let's zoom in on that. Here's that 5-wave move. Maybe you just want to trade until this 5-wave move completes and exit when you have an indication that it's over. That's another way to do it. Obviously, there's a little bit less potential there, just as in terms of the size of the move. But also you're not going to sit through as large of pullbacks, so you can have a lower pain threshold and trade that way. You could even decide you just want to trade this 5-wave move here, and once it's over, you want to get out, and that's basically just a week and a half of a move that you're trying to get out of. So you have to decide, what is your time frame? How big of 5-wave moves are you trying to trade? Because that is going to determine how you indicate your entry levels as well as your stop levels. Another thing I want you to take away here just on this time frame discussion here is the beauty of the Elliott Wave theory, and basically that no matter what time frame you're looking at, if you're in a trend, movement in the direction of the trend, so this is an uptrend, movement to the upside plays out in 5-wave moves. We can see it here on a 1-week time frame. We can also see it here on a 1-month time frame. Here's another 5-wave advance on a larger degree. So you can see every single move that is moving in the direction of the uptrend is a 5-wave move. Or if you step out, you can see, here's a 5-wave move that played out over the course of a year. That is only one wave of the larger 5-wave advance. So on every single time frame you're looking at, if price is moving in the direction of the trend, then it's going to play out in 5 waves. So you need to decide when you're building your Elliott Wave trading system, what time frame do I want to trade on? What size 5-wave trendy moves do I want to play? Because that'll determine when you need to exit. So the second thing you need to determine when you're developing an objective, tradable Elliott Wave system is when you're going to enter trades. There's a handful of different ways that you can do that, and we're going to go through it. The basic idea is that when a larger counter trend move completes and you believe that a new trendy move is beginning, that's when you want to buy. So you have a large counter trend 3-wave pullback, lasted about a year, a little bit over a year here on Amazon to the downside. As I said, counter trend moves play out in 3 waves. You can see this is a nice 3-wave move, very clearly a counter trend move. You want to figure out when you can buy with your best chance of success as a new trendy move begins, because obviously the goal is buy low, sell high. You make money. You turn your $40 into $140. that's a pretty good deal. So let's go through the different ways you can do it, and it's more or less a function of how aggressive you want to be. And there's pros and cons to each approach. So let's just start and take a look here. One way that you can do it when you know and you're expecting the start of a new trendy move, you can basically try to buy as soon as you have an indication that this three-wave move is over. This is really aggressive. You see a three-wave move, you're expecting a low, you see any type of strength emerge, and you buy. That is one way to do it. It's very aggressive, and the thing that is aggressive about it is that there's a greater risk that you are wrong. So you see this sharp move that happened here in looks like October. You might have thought, oh, that's a low. We have a three-wave pullback. Here comes the advance. You buy it really soon after the low, and you watch it reverse and continue down. So you would have to sell because you proved wrong. So if you use a really aggressive approach like this, a really aggressive entry level, just buying any type of strength at a point that a counter trend move may have ended, you're going to have more losses, no doubt about it. You're going to be wrong more often than you otherwise would. The benefit of using an approach like this is that it doesn't take much for you to find out that you are wrong. So if you thought this was the low and you see the strength here, it didn't take much for it to reverse and prove that you were wrong. So you would use you would have a really tight stop level. As soon as it's clear that you're wrong, you can get out, move on, things like that. That is one approach. And again, the benefits being that you can have a tighter stop level, but the con being that you will accrue more losses without a doubt. Another way you can do it, another way that you can develop an entry-level strategy is by looking for, when you think a counter trend move has ended, looking for trendy price action to the upside. So if you get this nice little five-wave advance that played out here, it'd be a pretty good sign that that a new trend has started. And so that would be your buy point. You would find the nice five-wave advance, you'd get the pullback, and it would start to break out again. You have trendy movement to the upside. That would be a pretty good indication that the advance is resuming and that you can buy. So this is a pretty good strategy. Obviously, your risk's a little bit higher because it would take a larger drawdown for you to know that you're wrong. But you're going to be right more often because you waited for an indication that the trend has resumed. So that's another entry-level strategy that you can use. Another one would be to look for kind of some help from Fibonacci. And the way this goes is you have your counter trend pullback again, and then you get this up move, and at the point that it retraces, 61.8% of this down leg here is a good indication, a very solid indication that this counter trend pullback is over. Because look at it in the other view. If you thought that this could potentially become a five-wave decline instead of being a three-wave move, and you don't know in real time, you don't know if it's a counter trend move necessarily or not, it can no longer become a five-wave move to the downside as soon as it retraces 61.8%. So this is a good, super solid indication that this is a counter trend move and that it's over. So you could buy it once it retraces 61.8% of this down leg here. That would be another strategy. Again, you're assuming a little more risk just in the fact that it takes a larger drawdown, a larger pullback to indicate that you're wrong. So your stop level is going to be a little bit further away. However, you're going to be right more often. You're going to have fewer losses because you've let this move develop enough to have a good indication that this counter trend pullback is over. The final way would be to look for a higher high. And I do actually know some Elliott Wave people that use this strategy. To me, it is way too conservative and you miss way too much of the move. But basically, you're having a complete retracement of this down leg right here. The third wave of a counter trend three-wave move. You're waiting for that to be completely retraced before you buy. You can see you basically watched Amazon double before you actually had your entry-level trigger. You're going to be right again more often, but you have a lot of risk to the downside because a large pullback can happen before you find out that what you thought was happening is wrong. So those are the four strategies you can use to enter trades. The one that I prefer personally is I like to see trendy upside movement on some small time frame, and then I want to see a counter trend pullback and the start of the next up leg. This is where I go. Yes, you do miss some of the leg, but you get fewer losses, and you can generally keep your risk fairly tight because if I think this is the first and the second wave, price heads higher, and then it breaks down from here, I know fairly quickly that I'm wrong. So think about it. Decide which one is the best way for you to set your entry levels, and do it every time. When you develop that as part of your trading system, make it mechanical. When you see a 5-wave move, there's nothing fancy about this. It's a very clear little 5-wave move, and you get the pullback. I know my setup's on. I know things are lining up in the right direction. Once I start getting the up move, no questions asked. There's no emotion involved. I know that's my buying opportunity. That is my entry level. Make it objective. Do it every time. The third step in developing an Elliott Wave trading strategy that you can follow objectively every single time you trade is learning when to exit, when to sell for a gain. And this is not as easy as it sounds, and that's why we're going to go through it here. So we've shifted it up. We've gone from Amazon, and this is looking at Apple now. So you have this 5-wave advance, and the goal when you're trying to sell is to sell as close as you can to the completion of a large 5-wave advance, because we know when a 5-wave advance completes in either direction, we're going to get a larger pullback in the other direction. So you have this advance here. It lasted over a year, so you knew a pretty substantial pullback was coming once this 5th wave completed. So your goal is, how can I know that a high is in for the 5th wave, and what's going to be my indication that it is time to exit because this 5th wave is over, and doing it without risking leaving money on the table. And I'll show you what I mean there. But again, the bottom line of trying to sell when you want to sell is doing it as close as you can to this 5th wave high, because you know a larger pullback's coming. So one way you can do it is, as soon as you believe that a 5-wave advance is completing and you see some type of weakness, you can sell. You can say, okay, that must be a high. I've seen enough. I'm out. I'm getting out of the way. Sayonara. If you would have done it in this case, obviously that would have been brilliant. You would have got out before a very large, time-consuming pullback took place here, and you look like a genius. Obviously, the risk of doing this is that you're wrong, and that the 5th wave did not complete, and that it's actually going to head higher, and you don't have any really great proof that the 5th wave is over yet. So you're taking the risk that you're going to leave money on the table. Let me show you an example of that. This is AMD. This is an advance back in 2018. Had this nice 5-wave advance. You had a 5th wave here, and then you saw that weakness. You said that's enough. You lost about 10% off the high right there. You decided it's time to bail. What happened instead is that the 5th wave extended. So when you're selling for 18 or 19, the stock actually reversed higher again and went to 34. So there is definitely some risk associated with trying to just sell once you see any type of weakness. More of kind of like an anticipatory type approach that you're thinking, okay, I'm wicked smart. I know a 5-wave advance is over. I saw a little bit of weakness. It's time to bail. So you can do it, and if you do it right, you get really close to the high, but you have the real potential of leaving a ton on the table if you're wrong, and this is not the actual 5th wave high. Another way you can do it is to look for actual proof that the 5th wave advance completed, that the entire 5-wave advance is over. The way that I do it, and another option for you, is to look for this 5th and final up leg right here to be retraced by more than 61.8%. Once it is, that's some solid proof that a high is in, and that would then be your sell point. So as the 5th wave is going, once the 5th wave begins, you put your stop level at a 61.8% retracement of this up leg. Once that level's hit, time to bail. That tells you to exit. That's another way to do it. A third way, and again possibly too conservative in my view, is to look for a complete retracement of that 5th wave up leg. Once you get that, that's your stop level. Obviously that's pretty easy to figure out. Once that 5th wave begins, you just place a stop level at that area, and once it's hit, that's an indication that the entire up move has ended. So those are the 3 steps to making Elliott Wave a tradable, objective, almost mechanical trading system that you can use. Look, man, there's a lot of money at stake here. There's a ton of people trying to make money. When you have money, this amount of money that's out there for your taking, there's going to be a lot of people that take it super seriously. You can't shoot from the hip. It's just not going to work. That's not how life works. There is no free lunch. Money's not just floating out there for you to grab. You got to take it seriously, and you got to study, and you got to develop a trading system that you determine works. For me, it's the Elliott Wave theory. It works. I've shown it a million times, maybe not that much, but several times through these videos here, and possibly a million times since I started using it over 20 years ago. So it's a really powerful theory. I hope this helps you develop, helps you learn how to develop a trading system that you can follow and not just talk about a theory, something that's just kind of out there that gives you a general idea of what's going to happen. You can make it mechanical. You can make a system that says, this is my buying opportunity. I see the completion of a counter trend pullback. Now I'm seeing some trendy strength off the low. So now that's my buying opportunity. Okay, I wanted to trade. I'm looking for a multi-month, 5-wave move based on the larger pattern. I know a multi-month move should occur. Once that 5-wave advance completes, this is what needs to happen for me to sell. Very objective, not emotional. It's just getting it done day in and day out. So you can be where you want to be, and you don't have to grind over charts. You can get that big fat bank account and go hang out on a beach somewhere. So this is Ryan with trendlizard.com. We're going to keep pumping them out. Please subscribe to this channel. I'm working hard trying to get stuff out for you that's valuable and useful. So please subscribe, and I will keep them coming. Have a wonderful day. We'll talk to you again soon. Bye.